Good morning, everyone. My name is Kevin Owens. I'm representing Seminar 9, Subgroup B, and today we'll be discussing financial instruments. To begin today, just a preview, we will go over financial markets, both capital and money markets, discussing their differences, and then each type of financial instruments used in both. First, we have listed the money market and capital market instruments divided by group in specific subtypes. We'll go over each of these and compare them to each other. We'll begin with the money market. First, we have banker's acceptance. Banker's acceptances are bank payments ordered on behalf of a customer. Their maturities are usually less than 6 months, relatively short term. The simplest way to describe these is like a post-dated check. So it's essentially a payment from a bank on behalf of a customer in the future. These are low credit risk as they're guaranteed by the bank, and they can be traded on the secondary market until maturity. Next, we have repurchase agreements, also known as repos. These are a form of short-term lending for dealers and government securities, where they're purchased and then resold the next day at a slightly higher price. It's a form of short-term borrowing. Next is the LIBOR rate, which is the London Interbank Offered Rate. This is a reference interest rate, and it's essentially the rate at which corporate banks believe they can borrow from each other at usually an overnight rate, but there are also longer-term rates involved. This is the premier short-term interest rate quoted in the European money market. That's from our textbook. Next, we have treasury bills. Treasury bills are issued by the government. They're short-term bonds used for the government to borrow. Excuse me. They're the most marketable and highly liquid of the instruments we'll discuss in the money market. Low transaction costs, price risk, and yield. That's because the risk of the government defaulting on them is very low, especially relative to a corporation, which may go into bankruptcy. One of the main features here is that income from T-bills is exempt from state and local taxes. Next, we have CDs, which are time deposits within a bank. CDs are very accessible. Even with as little as $100, you can get into a CD at your local bank. These are time deposits which don't pay interest as you go, but pay you the interest and principal at maturity. You can get your money out before maturity, but usually with a high penalty rate. Next, we have commercial paper. It's short-term unsecured debt issued by companies. These are relatively unsafe compared to the instruments we've looked at so far because there's no collateral. So most often these mature within 1 to 2 months, but because of their unsecured nature, they're often backed by a line of credit from a bank, which helps to mitigate some of that credit risk. Next, we'll move to the capital market. We're going to start with bonds. We've got 2 types here, government and corporate bonds. Government bonds include treasury notes and treasury bonds, which differ in their maturities. Notes 1 to 10 years and bonds 10 to 30 years. These have extremely low credit risk, just like treasury bills, because they're backed by the government, which again, relatively unlikely to fail. A subset of government bonds are municipal bonds, or munis. They're issued by state and local governments, which just like T-bills, only kind of in reverse, they're exempt from federal income tax instead of being exempt from state and local taxes. On the other side, we've got corporate bonds. These are on the private side, used by firms to borrow money from the public. The default risk is much higher than government bonds because because the risk of a corporation going under is much higher than that of the government. Next we have stocks. We've got ordinary and preferred shares. Their stocks are an ownership share in a corporation. Ordinary shares are what we commonly deal with as low-level investors. They're an ownership stake in a corporation, giving you a claim on that corporation's income. Some of the benefits of ordinary shares, they can be dividend paying, but we'll compare that to preferred shares. They have limited liability, and they'll grant you voting rights within the company. Preferred shares are a little bit less common for us. They're more of a fixed income instrument. They pay their dividends prior to any ordinary shares receiving their dividend payments. So if any dividends are not paid in a certain time period, those usually accumulate, and then cumulative dividends are paid before any dividends on ordinary shares. One major benefit is that corporations may exclude up to 70% of any domestic preferred dividends. And lastly, because they're fixed income, they're generally lower risk and yield than corporate bonds. Next are stock market indices. These are portfolios which are invested in the same proportion to general stock markets. So an example would be an ETF, which is traded based on the S&P 500, or an exchange-traded fund. There are several uses. These can be used to compare the performance of, say, a hedge fund to the market in general by analyzing the performance of an index. And these are great investments because they're much lower risk than buying a single stock. You buy one ETF, you're automatically diversified. Next are derivatives. We've got options and futures. Options here are a right to buy or sell an underlying asset. The key word here is the right to buy or sell. This is no obligation. It's just literally what the name is, an option to do so. These are highly risky. You can get into very leveraged positions, and you can make a lot of money or lose quite a bit. The contracts are standardized, and they can be traded on exchange markets or over the counter. On the other hand, we've got futures, which are contracts to exchange a good at some given date in the future. Now, this is an obligation to buy or sell the good. Unlike options where we had a right, futures contracts, you're obliged. There are no costs to enter a futures contract. It's just a contract between two parties. Options, you have to pay to get those rights. Okay? And again, futures contracts are standardized and traded on exchange markets. Now, to recap, we'll cover the characteristics of money and capital markets relative to each other. Money markets are shorter term. Capital markets are generally longer term with higher risk, but more often have higher reward. Okay? Money markets are very marketable because a lot of us can easily get into a CD or a treasury bill with entry points as low as $100. Whereas capital markets often include investments with minimum entry points of 6 figures sometimes. That's all. Thank you.